we're not in a global financial panic right now. We may be heading for one. We talked about that separately. We're not in one right now. We are in a recession. It looks the U.S. is definitely in a recession right now. We had 2 consecutive quarters of decline in GDP, first quarter, second quarter. Well, that's a recession. It may be prolonged. It may get worse. Europe is in a recession based on the latest data. Japan is in a recession. China looks like they're in a recession. They reported their most recent growth figures of 0.4% for the second quarter, not 4%, but 0.4% versus compound growth of over 10% for about 30 years. And they lie. So if they're admitting 0.4, I have to believe that's negative. So we're really looking at a global recession.
In this second part of the Jim Rickards series, building upon the insights shared earlier, Jim Rickards continues to dissect the global economic scenario. Contrary to immediate financial panic, he notes the ongoing recession in the US, Europe, Japan, and potential signs in China. Rickards then navigates through a historical perspective, tracing back to World War I and the suspension of the gold standard. The aftermath saw countries devaluing their currencies, leading to the 1920s when nations had to rejoin the gold standard. He details the repercussions of these decisions, particularly the UK's choice to maintain the pre-war exchange rate, which resulted in a depression 3 years ahead of the rest of the world. The Great Depression and its contribution to World War II set the stage for the Bretton Woods Conference in 1944. Rickards explains the conference's significance, highlighting the US-dominated negotiations that led to the Bretton Woods system and eventually contributed to the dissolution of the British Empire.
At the beginning of World War I, now it goes back to 1914, countries suspended exports of gold, suspended convertibility of gold. They wanted to hang on to all the gold they could. They knew that gold would be crucial. Gold was money, in effect, and it would be crucial in fighting and winning the war, so they weren't going to let any out of hand. So the gold standard prevailed through almost all the 19th century, really back to the kind of the post-Napoleonic period in 1815, was abruptly ended with the outbreak of World War I. Interestingly, one of the biggest advocates for not ending it, at least in the UK, was an advisor to the Exchequer named John Maynard Keynes. You know, Keynes is his reputation as this gold basher, gold hater, barbarous relic and all that stuff, which he never said, by the way. I actually tracked down the 1924 first edition of his works to see what he actually did say. And he was not talking about gold. He was talking about the gold exchange standard of the 1920s. But he argued strenuously in 1914 that the UK should not go off the gold standard. And the reason he said that was, we're not going to win the war with money or with gold. We're going to win the war with credit. Basically, you're going to have to borrow a lot of money to do this. And if you suspend gold, you're going to destroy your credit. But if you maintain the gold standard, you'll maintain your credit and be able to borrow far more and fight the war. And that's exactly what happened. Jack Morgan, based in New York, raised enormous amounts of money for France and the UK and no money for Germany. And that was one of the decisive factors. So now kind of move ahead to the 1920s. One by one, countries had to rejoin the gold standard. Gold standard was voluntary. There was no IMF, International Monetary Fund, at the time. That left them with a big decision, which is, what is the new exchange rate? There had been a pre-World War I, pre-1914 exchange rate. Each currency was pegged to gold at whatever that government chose. They would obviously try to do something that made commercial and economic sense. But you joined voluntarily and you picked your own exchange standard, so to speak. Of course, once you pegged to gold, you pegged every other currency in the world, because not everywhere, but all the major trading currencies, because they're pegged to gold also. And France and Belgium and Italy and a number of countries went back at a greatly devalued rate. It was they devalued the currency and raised the price of gold denominated in their currencies. And they did that. It was a simple recognition of the fact that they had printed enormous amounts of money to fight the war. If you were going to go back to gold, you either had to devalue the currency to reflect the increased money supply, or you could decrease the money supply, but that would cause a recession. So they basically inflated their currencies and went back to gold at a new standard. That's why, 1925 American expatriates were living very comfortably in Paris on relatively modest US dollar incomes, because franc was so devalued when they went back to gold. The one exception to that was the UK. And at this point, Winston Churchill, believe it or not, was Chancellor of the Exchequer. It was long before he was Prime Minister, but he was the head of the Treasury, in effect. And he felt duty-bound and honor-bound to go back to gold at the pre-war exchange rate. They said, a deal's a deal, a contract's a contract. People had faith in paper money. Let's maintain convertibility at the old level. Well, he did that, but as they suggested, you had to cut the money supply in half to maintain the new peg. That put the UK in a depression 3 years ahead of the rest of the world. We typically are depression in the US from 1929, but the UK was well in depression as early as 1926. Finally, in 1931, they had a banking panic. They did devalue at that time. FDR devalued the US dollar against gold. There were all these dominoes that were falling. And of course, the bank failures, bank panics, reduced world trade, agricultural output, and the Great Depression. And this was considered not only bad in and of itself, but a contributing factor to World War II. Created so much imbalance and so much irredentism and Germany's desire to take back lands that had given up to France and Poland and elsewhere, that it contributed to World War II. So here we were in 1944, before the war was over, but already Roosevelt, FDR, and Churchill were looking past the war and said, look, we can't let this happen again. We'll win the war. They thought they would win the war by 1944. But we can't win the war and then not have a good international monetary system. We'll repeat all the blunders and errors of the 1920s and be back where we started. So they convened the Bretton Woods Conference in Bretton Woods, New Hampshire at the Mount Washington Hotel for that purpose of designing the system. Now, there were about 45 or so nations present. Believe it or not, the Soviet Union, which was an ally, of course, of the U.S. during World War II, was present. They ended up not signing the agreement. An interesting footnote, but an important one, lead U.S. delegate was the Deputy Secretary of the Treasury. His name was Harry Dexter White. The Secretary of the Treasury at the time was Henry Morgenthau, but he couldn't be there full time. He was in and out. But Harry Dexter White led the U.S. delegation. The UK delegation was led by John Maynard Keynes. By the way, there were just, again, another footnote. The reason Bretton Woods, New Hampshire at the Mount Washington Hotel, and I was there, I've been there a number of times, but I was there most recently last week. It's in the middle of nowhere. It's absolutely beautiful. It's up in the White Mountains. You're right in the foothills of Mount Washington. So it's a spectacular place, nice place to visit, but really hard to get to in the middle of nowhere. The UK and the US were really the only important voices. And then the UK was really speaking for the entire Commonwealth, and they had a fair amount of gold. But this was really all about the US hammering things, compromising with the UK, and then coming up with something. And everyone else just kind of jumped on board. I'm sure there was give and take, but it was pretty much hammered out by the US and the UK. But in all fairness, it was really dictated by the US. Now, here's where it gets interesting, because Harry Dexter White was a Stalinist agent. And that was not, it might have been suspected at the time, but it was not really proven until the 1990s, after the Soviet Union fell and, Russia under Yeltsin, opened up the archives and scholars were able to go in and prove it. He was a Stalinist agent, and there were quite a few in the FDR administration. You don't have to be Joe McCarthy to understand that. And he was working on Soviet orders, and his orders were come up with a system that would destroy the British Empire. And he did, because the Bretton Woods system actually did destroy the British Empire. And the reason was that a lot of people think that, again, this is one of the misconceptions, all countries link their currencies to gold. That was the global gold standard. That is not what Bretton Woods did. Bretton Woods pegged all currencies to the US dollar. And then the US dollar was pegged to gold at $35 an ounce in the 1950s. It wasn't the sole cause, but India, I believe, went independent in 1947. And then throughout the 50s, the African countries, Singapore, one by one, they left UK. So it actually worked. And it did lead to the breakup with the British Empire. So it's kind of mission accomplished for Morgenthau.
As we conclude this insightful series with Jim Rickards, we've embarked on a journey through economic history, dissecting recessions, gold standards, and pivotal moments that shaped the global financial landscape. This marks the conclusion of a thought-provoking exploration into economic complexities and historical turning points. If you've followed along from the beginning, I appreciate your engagement. Stay tuned for more enriching content, and remember to subscribe for future updates. Until next time, navigate the world of finance with wisdom and foresight.